Good afternoon, and thank you, Steve. It's indeed a pleasure to be with you today and to address my first Hellaby annual meeting. I thought it would be useful to let you know, he said looking around, I thought it would be useful to let you know a little bit more about me and why I agreed to join Hellaby. After 16 years at Abano, I had announced my retirement when I was approached by the Hellaby board to consider the role of CEO Managing Director. And the beard's new since then, and it's still there, Steve. I've had more than the average CEO's experience of addressing shareholder meetings with respect to the takeover bids, and I was certainly not expecting to do that again. I had admired Hellaby for many years as a stellar financial success story in the early 2000s, and then as a remarkable financial recovery story under John Williamson's stewardship from 2008 to 2015. From 2000 to 2005, Hellaby was a share market darling as it bought and bought and bought and bought an astonishing array of New Zealand businesses and positioned itself as a listed investment holding company. However, following a steep fall from grace from 2005 to 2009, there was a strong financial recovery story which was achieved from 2009 to 2013. And the market recognised the work that was being done, albeit with a conglomerate discount. However, from 2013, the share price stalled at around $3, even though Hellaby's financial performance continued to materially improve. So why did this happen? When I look at the value of businesses, I look for three things: growing financial performance with an established track record of solid EPS growth, very good communication processes, and lastly, a clear and compelling strategy that captures investors' imagination. Now, notwithstanding the 2016 result that we've just had, Hellaby was clearly a financial success story. I then looked at the Hellaby communication material and I was impressed, so much so that I filled in the Institute of New Zealand Financial Professionals application form, and lo and behold, he said, going the wrong way, we won the INFINS category for the best corporate communicator, and so that left the only thing that was outstanding was the Hellaby strategy. When I asked shareholders and investors what they thought, the answer was broadly the same. Hellaby's a great company, a New Zealand Stock Exchange icon. But what do you do? As I said, as a listed investment company, Hellaby has owned an astonishing array of businesses. The company positioned itself with the byline of buy, build and harvest, and the list that you can see up on the screen are just the businesses that Hellaby owned when it was run-off corporation. Our new strategy, after a careful analysis of the existing business groups, we agreed that two of these groups operated in large, scalable markets and that both offered very attractive investment opportunities: the automotive group and the resource services group. A third core group was considered, but the equipment group offered investment challenges, and midway through our review process, we were approached by Maui Capital to buy this business. On the 30th September 2016, we received $81 million in consideration, and Peter Dutson and the equipment group team are now in safe, compatible, competent hands. The fourth group, which we have reaffirmed as being non-core, is the footwear group. When I talk to Hellaby investors and analysts, there's often a wry smile when we mention footwear. Yes, the footwear group has been for sale since 2008, and for a variety of reasons it never sold. The core problem, in my belief, is that Hellaby never said, retail footwear is not core. In addition, just because we own the equity in a business does not make us subject matter experts. So we removed the group from all sale processes, and we've appointed 2 full-time experienced retail experts and an expert advisory board member to advise and implement significant structural change and position this group for sale in about 24 to 36 months' time. I absolutely acknowledge today the management of that group who are here, and in particular I recognise David Gordon and Stephen Cook, and I thank them for their steadfast support through an almost decade-long sales process. We will find you safe, committed owner who can share your vision and who can assist you in achieving that in the years ahead. However, to the Hellaby shareholders, be clear, footwear is non-core and it will be sold. So let's have a look at what happened in the FY 2016. Sales at $795 million were marginally up on 2015, but the earnings at $46.8 million at trading EBITDA and $31.4 million at trading EBIT and $19.6 million at net profit after tax were well down on FY 2015 and only slightly up to flat on the previous 5 years. In December 2015, we issued market advice that the first half of the FY 16 year would be well down, and again we issued guidance again in May for the full year. While our actual performance came in at the upper end of the full and the half year, it nevertheless was a disappointing performance and it was an abnormally soft year. The FY 16 performance was primarily a result of a very soft and volatile year in contract resources, the only business that was in the resource services group for the year, as well as soft year-on-year performances from both footwear and from equipment. Contract resources saw revenues fall by $13 million, and with high fixed costs of mobilised but idle crews, saw EBITDA and EBIT fall to lows of $11 million and $2.9 million respectively. This business is a market leader with an international reputation. It has a high market share in the specialist oil and gas sector, and as a result was heavily affected by shutdown delays which were caused by very low international oil prices. Important lessons have been learned, and a new strategy has been implemented to diversify revenues and de-risk our reliance on short-term high-value contracts. The acquisition of TBS Group and the appointment of Ivor Ferguson as our new CEO for this group are absolutely central to this strategy, and Ivor will cover that later in his pre-recorded video address. The next impact was Footwear Group, which continued its soft trading performance with same-store sales down again for the 4th year, and as a result revenues fell by $3.5 million, with earnings at EBITDA and EBIT falling to lows of $4.3 million and $1.3 million respectively. Again, a high fixed cost business with 117 stores around the country and over 1,000 employees. Hellaby has received indicative offers on this business in the last 12 months. Those offers, we believe, were opportunistic. The board carefully examined the last offer, which would have required a multi-million-dollar write-off, and we determined that implementing a restructure plan was in the best interests of our shareholders, as it avoided a multi-million-dollar write-down of shareholder funds. It is a good plan, and it's put together by retail experts, not by the people that own the equity. As a consequence, we believe it will not only reduce costs, but this plan will change the trend of the business performance, making the whole footwear group more profitable, more valuable, and therefore more saleable. The restructure plan has been agreed and is now being implemented. This will result in abnormal costs to footwear of about $6 million in the FY 17 year, more than offset by the one-off $30 million odd gain we have realised on the sale of our equipment group. The equipment group, while a solid performer, also experienced falling margins, partly because of a change in the sales mix and partly because of a weaker New Zealand dollar. The business was conditionally sold to Maui Capital in May, and we received $81 million on settlement a few days ago on the 30th of September. Finally, the automotive group contributed very well in the period, benefiting from acquisitions, but also seeing good core growth in its mechanical B&T businesses, which was offset by some softness in our battery business group. Revenues were pleasingly up by $59.6 million, with earnings modestly up by $1.2 million and $0.6 million at EBITDA and EBIT. This followed extensive investment into strengthening the management team and in start-up costs associated with our move into truck and trailer parts. This business group has a stunning future ahead, and Colin Daly, who is here today, will present to you his vision and our vision for that group. An enormous amount has been achieved in the second 6 months of FY16. The Hellaby corporate office was restructured with 2 senior positions removed and annual savings of over $1 million per annum. The equipment group was sold, and the gain of approximately $30 million will be included in FY17. We acquired TBS Group, adding $85 million to revenue and $8 million to EBIT, diversifying and underpinning our contract resources business and establishing a new complementary model to roll out around the world. We acquired Premier Auto Trade, a specialist auto electrical business, which is merging with Jazz Oceania in Australia. This is making Hellaby's auto electrical group an emerging leader for internal combustion solutions, as well as the important channel in the diversification that we see coming as electrical solutions grow as alternative transportation energy sources. We carried out a global search process and secured Ivor Ferguson as our new CEO for the Resource Services Group, adding breadth and experience to an already talented team. And finally, and most importantly, we have a clear understanding of who we are, where we are going, and what we're about. We recently looked at this plan and at the achievements of the last 6 months to the market. Richard Jolly, our new CFO, and myself attended 13 meetings, as Steve said, around New Zealand in the last 3 weeks, talking to investors, shareholders, brokers, analysts about Hellaby and Hellaby's strategy. The plan was to hold around another 8 investor meetings, but we were cut short by the Bapcor takeover when Steve Smith called me midway through a presentation in Invercargill, and a very startled Richard Jolly and I returned to Auckland. All because someone else valued our strategy and your business and was proposing to bid on that company. The pleasing thing was that at the time of the call, Hellaby's share price had risen to $3.04, and post our 12.5 dividend record date, making it effectively $3.16 to $3.17, with average daily increases over the previous 10 days of 2 to 4%. The Hellaby story has always been there, but it was lost in the confusion of a listed investment holding company. The true focus is now clear, and it is now just emerging. We have an attractive future and an opportunity to build something quite special going ahead. In fact, our suitors' own ASX success is similar to what we can achieve. They have a market capitalisation that is over 4 times that of Hellaby, and that is exactly our opportunity. And that is exactly why they want to buy Hellaby. The hard yards have been completed, and your company is in great shape with expert staff, great management teams, a strong board, and a very strong balance sheet. We have a clear understanding of who we are and where we're going and what our focus is. We're well-resourced, well-positioned to achieve $1 billion in revenues with a 10% EBIT in 5 years' time. I will now hand you over to Colin and to Ivor, who will talk to you about the future looks like in their respective groups. Thank you.